Hello, welcome back. Now, so in our last video, in our last session, um, we had only analysis of this part, discount rate calculation part, left, and it's not just the discount rate, but there are um, all other relevant factors that are also then that are involved in the calculation of basically uh, cost of equity and weighted average cost of capital. Now, first, think about it. To calculate the cost of equity, right, we need to use CAPM. That's why there is beta, right, current beta. But then we will have to separate the unlevered beta, from the levered beta, because levered beta means literally when we have leverage, right? Unlevered beta means when we have only equity, when we are considering the beta with only equity. So in other words, unlevered beta will be used for calculation of cost of equity, and levered beta will be used for calculation of weighted average cost of capital. Now, so to calculate then beta, we need risk-free rate and market risk premium, right? There are a whole bunch of other factors that need to be considered also in this particular section. Now, so let's take a look at the. But before we look at the levered beta, first, in the last segment, right? Calculating, we did a little, no, it shouldn't be there. I did it alternatively, and it didn't come out right because I forgot to put comma here, right? I had to put comma. Basically, I summed all the positive terms, right? And then subtracted sum of all the negative terms. And then, so in other words, this is exactly this structure, right? Okay, so that worked. I was trying to show you that. Okay, let me get rid of that now. Oh, why is there any? Okay, let me leave it there. It doesn't really hurt. Now, so here, let's and as I always, as usual, only the highlighted cells are calculated cells, calculated results, calculated values. The others are all given, right? The blank, non-highlighted cells are given. Current beta is given, they just took the beta from like, a value line or Morningstar. Terminal growth rate was already given, tax rate is given, right? And return on debt, in other words, interest rate or cost of debt is given. Risk-free return is given. And think about it. The return on debt or cost of debt and risk-free return are pretty much, the same, pretty much, aligned. Uh, nothing is more risk free than the treasury, right? So even if this company's debt is high quality, like triple A or double A, at least it will be there should be some risk premium, default risk premium. That would be 0.005, okay, which is 0.5%. Uh, the numbers look quite similar, but don't get mixed up. Don't model up, a tax rate with this because tax rate is 35%. This is only 3.5. This is 3%. So our debt is, our bond is like, just 0.5% more riskier. Or, I mean, the risk premium is 0.5%. That market risk premium. What's market risk premium? It's the market return, average market return minus risk-free return. That's market risk premium, right? So that means market. What does that mean? Our what is our market average market return? That means our market return would be 11%, right? Ah, so, okay, it's like N, right? All righty. And before we go to unlevered beta, let's take a look at how they got the market value of equity. And also, I said, I told you, if not genius, I mean, it's not genius to do this, but it's very clever. If you look into that, it's C3 times C11. C3 is what? Price earnings ratio. C11 is the profit EAT, profit after tax, net profit, right? Now, why do they multiply these two? Because think about it. What you're multiplying is basically earnings per share times price earnings ratio. Earnings per share times price earnings ratio, right? This EAT is actually, this aggregate, right? But what is EAT? EAT is because it's an aggregate concept, right? Oh, I'll have to. Looks like I'll have to get out of there first, which is my out of there. Yeah. What is the difference between EAT and EPS, earnings per share? Literally, earnings per share is per share. In other words, if you divide this by number of shares, then that's earnings per share, right? And so EAT is earnings per share times number of shares. Okay. So then, and then think about it. if you multiply earnings per share by uh, price earnings ratio, then earnings per share and earnings per share, they cancel out, right? And it becomes just price, right? So then uh, blow it up to, this is per share level. You blow it up to aggregate level, right? Then what does it become? It becomes value of equity equals, right, EAT. Drawing this is really EAT times price earnings ratio, right? You get that if you blow it up to aggregate level. And it's always, this little mind. It's like a pet peeve to me because those this is a pet peeve. Actually, I don't, aesthetically, I mean, it cannot be aesthetically perfect because you're drawing with a mouse, but then I just don't feel um, I just feel uneasy with minor details like this. Well, anyway, now let's take a look at so that's how they got market value of equity, right, at the beginning, and here, and since we have that only for first year and the last year because we have uh, those were given data in the first place. This 27,000. That must be million because in reality everything is in like $1,000. So if it is 27,000, that's actually 27 million, right? Cash. Uh, if it is Honda Motors, it would be more like 27 million, right? That is yeah. Anyway, so our market value of equity, for the first and the last year, we got it like that. Now let's think about, what is unlevered beta? Yeah, isn't that beta good enough? Well, this beta is only for this year. I mean, the most recent year, which is like the past. It, the most recent data, annual data we have now is 2019 data, not 2020, because 2020 isn't over yet, right? So then think about it. Um, year year after year, right? The leverage will change, the capital structure will change, right? Capital structure will change, and then because there will be a change in debt, right? Debt level, right? And therefore, weighted average cost of capital will have to change as well. So beta will have to we'll have to think about first. The beta will have to reflect that weighted average cost of capital because, and that's called levered beta, and um, uh, the other one is unlevered beta. If you're looking at only the beta based on the equity alone, right? So how did they calculate this? Okay, the formula, they use this formula. Where did that formula come from? Uh, I basically I got the idea from uh, the capital structure. I mean, the basically the ratio between levered beta and unlevered beta should be equal to the ratio between the total capital and um, value of equity. Okay, makes sense, right? Exactly that ratio should also uh, be the ratio for between, so then if you solve this equation for, uh, this is unlevered beta, right? Well, then, it will come to this, right? It will come to this. Now, then, if you solve this equation for then levered beta, right? It's just, algebra, rearranging, terms, solving this for levered. I mean, this is the denominator, numerator. So all you need to do is multiply this by this, okay? And then rearrange, a couple of things. Um, and I'll come back to this, at the bottom, in the denominator, value of equity, it can be simply switched to 1 minus value of D over value of C, right? Because this is a ratio, right? If we express everything by ratio. So expressing everything by ratio, right? So anyway, let's go to then. So this is how I got, currently, right? Uh, you see the formula here. I cannot, when I click on it, it doesn't, spread it. It doesn't spread it, horizontally because uh, the window pane is there, right? Uh, but you can see what's there in here, right? Which is exactly uh, this. Okay. So B21, okay, which is what B21. Yeah, that's the current levered beta. Current levered beta, right? Okay. Current levered beta over 1 plus 1 minus tax rate, right? Which is, 1 plus 1 minus tax rate times C5 over C28. C5 is obviously value of debt, right? C28 is value of equity. Yeah, market value of equity, long-term debt, right? So it's exactly how that formula came about. Okay. Now this is nothing. They gave this is the formula they used, but where did that formula come from? I mean, on 300 level, you should be able to uh, understand. You should be able to uh, deduct it, or deduce. In deduce. You should be able to logically deduce it, right? It's called deductive reasoning, right? Um, so, oh my God, maybe the microphone is on. Good, good. I thought this whole time I've been This whole time I've been, pouring out my soul, but if my sometimes I see, only realize, after recording 30 minutes, then I realized the microphone was off, and then, oh God, it's all, just wasted, right? I have to do it all over again. Okay, but I just confirmed that the microphone is on. Good. Because if I were to redo it, I cannot redo it. It cannot be exactly the same thing. So this is actually, it says current beta. This is actually current levered beta, right? This is current levered beta. And then levered beta. It's not a difficult thing to find, debt ratio. This is because, value of debt over value of company, right? So that's debt ratio, right? So let me change this to, actually, I want to change that. Instead of saying debt, how about, why is it not uppercase? Value of debt over value of, so value of that, I'm going to turn it into a subscript. I want to make it the whole thing bold. The whole thing is gotta be bold. The whole thing. Okay. And we know what to do then. C5 is, we know it's debt, and C5 plus, this value of equity, right? Market value. That's total capital, right? And then we have actually, based on actual data, we have only for 2014 and 2018. So the rest of them are linearly smoothed out, right? Linearly smoothed out. So simple average, using simple average, right? Linearly smoothed out. Yeah. Why is it always? No, don't show me. Just show. Okay. See the how they did it. Spread it over 4 years, and just increase, annually, and right, 2 times, because it's the second year, right? Now, then leveraged beta, calculating leveraged beta using this formula, right? Using this formula, right? Calculated leveraged beta. Okay. And there you go. So it's all done, right? Each year. Just, do this and just drag it across, right? And cost of equity is calculated by CAPM, right? And everyone remembers what CAPM is. I'm going to have to move this here. Okay. And we all know CAPM is what? Risk-free return, RF, so annoying, RF plus market risk premium, right, which is average return on the market minus RF. That looks like gamma, but that's not gamma. R right times beta. And in this case, levered beta or unlevered. It would have to be unlevered beta, right? Okay, done. So, levered beta because we want to use, we want to do it for, use it for weighted average cost of capital, right? So I'm gonna stop this, right? And then do it for every year for different different beta, each year, right? Because they have, levered beta, and just run across, right? Drag it across. So then, weighted average cost of capital is simply, is the, weighted average, right? Or weighted sum. C31, of course, C31 is, cost of equity times, weight, 1 minus C29. That's the weight, in other words, proportion of equity, because, C29 is proportion of debt. So 1 minus C29 will be proportion of equity, right? The weight of equity. It happens to be really, just really, 50%, but it linearly, declines over time. So that means, equity, equity proportion, increases. And then, this is cost of debt. Equity proportion increases linearly. And then, C29 is the weight of debt. But, we use, the tax shelter, right? Or minus tax rate. So actually that is, the actual proportion of debt in the weighted average cost of capital, right? And then you do that, just run it across, right? And if you were to drag it across, the values like, E29, no, they have to adapt, right? Because, and then calculating, this is just to make it easier, because otherwise you would have to do, discounting by, 1 over, something over, all these, free cash flows over 1 plus, R raised to N, right? So they did it already here, right? They did it separately, calculated the factor separately, right? So, in other words, you might wonder, why is it not, this, shouldn't it be raised to, shouldn't it be squared? Instead of, if you're discounting it from, all the way back, from here, then of course, then the numerator will be this 1, and then, discounted, like, discounted twice, or, squared, right? But then you're just discounting in one period back, and then this one is already discounted, right? So that's the idea, right? And you discount it only back to this. And this one is already discounted back to this. This one is discounted back to this. So, it's the same effect, right? So finally, we got the discount factor for free cash flow to the firm. We got the discount factor for the free cash flow to equity, right? D31, E31, and so on, right? And then now all you need to do is discount those free cash flows up there, right? And if you discount it, right, D17, which is the free cash flow data there, right, and so on. You drag it all the way to the right. Drag it all the way to the right. And then finally here, right, we have the present value of free cash flows, right, as of the end of 2014, right? Everything is as of end of 2014. And then free cash flow to the equity holders and so on. All right, so that's how we got to the intrinsic value per share through a free cash flow model. Okay, we have run out of time. I just wanted to show you, actually I wanted to show you the, see here, how to use, name range, but we are out of time. Maybe, briefly discuss it, in the next video. Okay. Oops. All right. That's it for today. For this video, I'll see you guys in the next video. And stop